it is also possible that a company, this is a company's balance sheet. Let's take an example. This company may make investments in other companies. This company may make investments in other companies. So this company has bought shares of its subsidiary companies. This company has bought shares of its associate companies or other companies or joint venture companies. Different forms of companies exist. Whenever this company has purchased shares of some other companies, you just have to see only one thing. Again, if you ask me that is it the lookout of the stat auditor, I will say this point is also more or less like an internal audit point. More or less. This company, when it is dealing in shares or securities or debentures, so here investment could not only be in shares, it can also be in debentures. What I mean to tell you all here is that whenever this company is making investment in other companies, just check one thing, that this company is maintaining proper records or not. Now sir, give example of some records here. The company has to maintain investment register. For fixed asset, maintain fixed asset register. Inventory, stock register. Investment register. This register should be periodically updated. Timely entries should be passed. If the company receives dividend, pass dividend entry. Sometimes company receives pre-acquisition dividends also. Now I don't know whether you know the concept. What is pre-acquisition dividend? What is it? Come on, tell me. What do you mean by pre-acquisition dividend? Pre-acquisition dividend is something which you receive even before you are an investor. You are receiving dividend for the period even before you are an investor. You know, generally pre-acquisition dividend is reduced from the cost of investments. Which standard says that? So you have to see whether the entries have been passed for pre-acquisition dividends, post-acquisition dividends or not. Post-acquisition dividend will be charged to profit and loss account, credited to profit and loss account. Simple. Whenever the company is having investment in some other companies, definitely the company would get some share certificates. Verify the share certificates physically. To see whether the name of the company which has made investment is printed on that share certificate or not. If you keep money in fixed deposit bank account, the bank will write your name. To your name or to your joint holder's name. Joint holder means I am talking about nominees. Suppose if you are not able to take the liability of getting, the bank is not giving you back for you, the bank is not, you are not the person who is having the liability. Your nominee will be there. Nominee is also appointed by the depositor only. Who appoints nominee? Depositor. So if I deposit money with the bank, I can appoint anybody. He should not be my necessarily relative. Anybody can be my nominee. So the name of the nominee should be printed on the share certificate. When you do audits, when you do physical checking of share certificates, you must see all these points into detail. One point is that the company has to maintain investment register. Second point, in the investment register, timely entries should be passed. Journal entry, just have to pass normal journal entries. Make sure that the investment register contains all the entries of not only the post-acquisition but also of the pre-acquisition dividends. And if the shares are issued to the company, the share certificate should have the name of the company. It is in its own name, the share certificate should be there. So suppose if company X has invested in shares of some other company, say Y Limited, so X Limited's name should be printed here. Or if X Limited name is not printed, then the name of the nominee should be printed here. Sometimes in the share certificate, you will find that the name of both the holders are printed. They are called as joint shareholders. You know, when you get a share certificate and you are a joint shareholder, who will have the voting right to vote? Have you ever thought of this? A joint shareholder, a share certificate may be having 3 joint shareholders, 5 joint shareholders. It does not matter. The name of that shareholder who's first appearing in the share certificate will only have the voting right. That means even if the share certificate has 5 joint shareholders, only one shareholder can vote in the meeting. Others will just look at his face. That is the concept. So joint shareholder certificate, voting right is always in the name of the first shareholder whose name appears first in the joint shareholding pattern. So you have to verify all these points. And what I'm saying, nominee point, that if the name of the company is not written, then the name of the nominee of the company should be written. It is also written in section number 49 of the 1956 Act. So normally companies are exempted to write their own names, or the company will say, I have appointed a nominee, write his name. How does it matter? Ultimately, nominee is also going to take the responsibility of the depositor only. Have you understood or not? So you have to verify these three conditions. Check proper records. See whether the shares are in the name of the company, own name. Is it okay? Fine. Otherwise, see whether it's in the name of the nominee or not. That's it. This is your clause number 14. If you feel like copying anything, you can copy. Otherwise, the clause is printed in the textbook. Page number 38. I want people, those who are not writing anything, please read clause number 14. Now understand the concept first. What is happening in this transaction? Guarantees given for loans taken by others from banks or financial institutions. The heading is little technical, dicey to understand. Guarantees given for loans taken by others from banks or financial institutions. What does it mean? If you are the CARO auditor for this company, suppose if you are doing audit, you are preparing the CA-RO report for this company. This company has given guarantee to the bank, but this company has not taken the loan. The loan is taken by some other person or some other company only. This other person can be a company, or he can be even an individual. So this company went to the bank, it took loan, and this company gave guarantee to the bank. As the CARO auditor, you have to just see that the terms and conditions. So terms and conditions of guarantee should not affect this company, or it should not be harmful to this company. You know, yesterday I told you one word, prejudicial. Prejudicial. Have you understood? It should not be affecting this company. So if this company gets affected, what will happen? It will affect the interest of shareholders. Now I'll give you in numerical amounts. If suppose this company took a 3 crore rupees loan from the bank, and this company had to pay 2.5 crore to this company. Say there was first this transaction took place, and then this transaction took place. Number one, this transaction took place. Number second, this transaction took place. First, this company has to pay something to this company, and then this company goes to the bank and takes a 3 crore loan. Now, how much is payable to this company? 2.5 crore. How much is this company going to pay to the bank? 3 crores. What this company will tell to this one, instead of giving me 2.5 crore, you directly deposit in the bank, because I am having the liability of the bank. This company said, okay sir. Later on, they came to a conclusion that the bank is demanding 3 crores from this company, whereas the liability of this company towards this company is only 2.5 crore. So now this company can take advantage like this. So what you should do, you should read the terms and conditions of the guarantees given. So when this company is acting as a guarantor for this company, then the terms and conditions should not affect the interest of this company. Have you understood or not? So the best way of understanding this point is you don't have to do research, just have to read the agreement copies. See what is a MOU between this company and the bank. Because see, in any case, banks are not going to leave you. There is the only form of organization which never makes a loss is the bank. It will always be in profits only, and loss-making person will be the client of the bank. So now this bank is not going to leave you. Bank will say 3 crores. Now why should this company pay 3 crores when the liability of this company towards this company is only not 3 crores, it's 2.5 crores. So just see the amounts properly, see, and the conditions are also small. So you have to read like a magnifying glass, you have to take and start reading. Because the conditions are so small, and if you skip one condition, the company will blame you also. Why I have appointed you as an auditor if you are not reading all these points? Then what is the need to have a statutory auditor? So if the terms and conditions affect the interest of this company, they need to be reported in CARO. And you see, every clause of CARO which I am teaching you now, almost we have done 15 clauses. Every clause is talking about different point, and it is covering different aspects, so that controls can be strong. Ultimately, it's a matter of control. Though a stat auditor is preparing CARO report, but it is a matter of control. Have you understood this transaction? So you can copy the diagram as well as it is given, as well as the concept is given on page 38, clause 15. Now the next two clauses are small and they are easy also to understand. Clause number 16. Whenever you are a CFO of a company, I told you that the ability of CFO can be judged from the quality of decisions that he takes. So if you are a CFO of the company, just one question which I want to ask you is that suppose if a company has taken a term loan to purchase fixed assets. The company took a term loan to purchase fixed assets. It took a loan from bank. But then the fixed assets which were purchased include, so suppose if the term loan taken was say 10 lakh rupees from a bank to purchase some fixed assets, out of which 1 lakh rupees was used to purchase air conditioner for the director's home. Fixed assets will be used for the business purpose. But 1 lakh rupees out of, so 9 lakhs was only applied. Term loan taken 10 lakhs, applied 9 lakhs only. One loan, 2 ACs purchased for director's home, 2 ACs. Is it okay? Is this transaction okay? It needs to be reported in CARO now. Because again, the term loan is applied for the purpose for which they are obtained, fair enough. But if the term loan is not applied for the purpose for which they are obtained, report in CARO. Have you understood? So what will you write in CARO that out of 10 lakh rupees, 1 lakh rupees was used to purchase 2 air conditioners for the director's personal purpose, for home, etc. You have to write this thing in CARO report. So again, it will be a control check on the people who are misutilizing the term loan. And who will be the guilty blame person here? The CFO. How did the CFO allow this transaction to happen? He is a chief financial officer. He should not allow such transactions to happen. That's the clause. You can simultaneously read it from textbook. Just one line only it is written. Huh? Only one line. The heading itself is the clause. Next one, clause number 17. Now, to some extent, this clause and the 16th clause which I taught you are the similar clauses. There are minute differences here. Now, here what is the difference? Short-term funds are used for long-term purpose. That's the difference. Suppose if you go to a bank and take a working capital loan. Working capital loan means the loan which will be applied for meeting your day-to-day operations. But then you landed up purchasing fixed asset out of that money. Now suppose if you purchase a machinery, whereas you told to the bank that I will be using this money to purchase raw materials, and you purchase a fixed asset machinery. Tell me, now will the machinery be of any use if you don't put in some raw material? So you have wasted your money. Again you will go to the bank and again you will purchase some other loan you will take and then you will purchase. When you have taken loans, working capital loans are generally given at higher rate of interest. And long-term loans are at the lower rate of interest. So if you go to the bank will tell you this high rate of interest is 13.99%. But if you would have told me fixed asset loan, I would have given you at 10.25%. So you are, first of all, you are paying high rate of interest also, and secondly, you are misutilizing the loan. You should have taken working capital loan for working capital purpose only, not for long-term purpose. But see, what is the difference between this clause and the earlier one? There, the money was used for some other reason, not for the reason for which it was taken. But here we are just classifying it as short-term and long-term. So the only difference is here it is short-term, long-term classification. Now suppose sir, if this working capital loan was given to the director to purchase AC, then it would be covered in clause 16. Have you understood or not? Here it is used specifically for business purpose only. There it is used for some other reason which is not a business reason. So accordingly you have to decide here whether to cover it in 7. Again, a chartered accountant get confused here whether should I write it in 17 clause or 16 clause. I am making that thing clear. If it is a working capital loan, use it for working capital. Fixed asset loan, use it for fixed assets only. Clause number 17, you can read it. The next thing which you have to see is, again this section has come. So in CARO, this section has come 3 times. The third time. Before I explain you this point, it's a very small point, but you read that note on section 301 which I dictated today. I dictated a note on section 301, please read it. In that note, I had dictated 3 examples to you all. The last example was on shares. If shares are given to the section 301 party, then it should be given at the market price only. That example correlates to this point. In front of it, if you want, you can write there also. Clause number 18. Refer clause number 18. So that's the share example. And the sale purchase example, you can write which clause? Clause number 5. And the loan example, you can write clause number 3. So there are 3 clauses on section 301. Now what I need to tell you all here, please understand. Only one thing, what do you mean by preferential allotment? See, preferential allotment is not allotment of preference shares. I am not talking about preference shares here. Preferential allotment is not the allotment of preference shares. Preferential allotment is given only to some selected category of people. Selected category of people. Sir, give some examples. Selected category would mean something like the promoter of the company, or some party like interested directors who are covered in section number 301. Generally, these people are allotted shares of the company at a much lower price than the market price. Do you know that as per the Companies Act, whenever you give any preferential allotment to select category people, you have to always take approval from shareholders, and shareholders can only give approval by passing a, then I will teach you what type of resolutions they pass, but then it will take some time. Shareholder will always give their decision. Resolution means taking a decision. The shareholders decide only by way of resolution. What I am trying to tell you all here is that even if the shareholder took a decision, yet you gave them shares at a much lower price. Shareholders will agree that okay, since this person is an interested director or a promoter, you give him at a little lower price. See, the price at which shareholders take the share is say 10 rupees. But the price at which these interested directors should take the share should be say 9.5 or some reasonably fair price, justifiable price. It should not happen that a shareholder is buying at 10 and these people are buying at 1 rupee. Very low than the market price. This is not allowed. So if auditor uses his professional judgment and if he feels that the preferential allotments are paid at a price which is prejudicial to the interest of the shareholders, it is harmful to the shareholders, he can write that point in CARO report. Why should a interested director take more benefit when the shares are purchased by the other people also at the same price? He should also take it at the same price only, and the shareholders will agree. See, shareholders won't say no to this point. They will say that, sir, we are taking a decision, we are passing a resolution, you give them the share at 9 rupees. Shareholders will not mind this. But if you are asking for 9 rupees, approval of shareholders for 9 rupees, and then purposely you allotted them at 2 or 3 rupees, this is unjustifiable to the shareholder. Shareholder is not going to accept this thing. So in that case, if you want, you can write this point in your CARO report. So whenever there are any preferential allotments made to interested, see, this point is not covering the concept of promoters, but the concept of preferential allotment covers promoters also. The CARO point is not covering promoters. CARO point is only covering these people, the section 301 people. If a promoter is also an interested director, then it will be covered, because a person should fall in this category to be covered by CARO. Whereas preferential allotment is a wider concept which also covers promoters. So now what I am telling you all, that if an allotment is made, so allotment should be allotment of shares, but preferential allotment does not mean preference shares. It means equity shares only, but they are allotted at a very less price compared to the market price. So it needs to be reported by the auditor, because even after taking the approval of shareholders, if you're still allotting them at a very lower price, it is doing you're being injustice to the shareholders. You're doing injustice to the shareholders, which should not be the case. So then the shareholder will see this and then they'll really get angry. When we pass a resolution for 9 rupees, how you can give them at 3 rupees? Have you understood or not? That is preferential allotment, clause number 18. Please read it. And if you want something, you can. So I will just give you one line, you write there only. Circle that word preferential allotment. In the textbook, circle preferential allotment and you write there. Preferential allotment does not mean preference shares. Preferential allotment does not mean preference shares. But it is an allotment made to selected category of people, like the promoters, or interested directors. Full stop. You have one more line to write. You have space there. Space is over. I will still dictate. Preferential allotments are generally made at lesser than market price, by obtaining special approval from shareholders. Have you understood this point? Next is clause number 19. Now just 3 more remaining. Clause 19. Please pay attention. Security or charge is created in respect of issue of debentures. That is the name, the heading. Security or charge is created in respect of issue of debentures. What does it mean actually? Suppose let us take an example of a extract of balance sheet in which it is given debentures and it is given on the asset side land and building, and it is written that debentures are secured against land and building. That means the company has issued which debentures? Secured debentures. Though in India companies are allowed to issue unsecured debentures also. What is the advantage of issuing secured debentures? These debenture holders have a person who will take care of their interest. He is called as debenture trustee. What is the name of this person? Trustee, having trust. Now, these debenture trustees are from amongst the debenture holders only. So, suppose if there are some debenture holders, let's take examples. these people will mutually decide who will become a debenture trustee. So finally he became the debenture trustee. Now when this person becomes a debenture trustee, he will make sure that the interest of himself as well as other debenture holders is protected. Even he is the debenture holder, even he has investments in debentures. Even the company has taken loan from this person, he is also a debenture holder. So suppose if the company does not redeems the debenture, this trustee will make sure that he will approach to the High Court, he will get the orders from the High Court, and the High Court will also appoint a liquidator for them, and they will go and they will start liquidating the assets. What does liquidation mean? Sell this asset, generate cash, and get the cash paid to the debenture holder. So it is whose job to do? It is the job of the trustee. The debenture trustee will look after their interests. So whenever debenture holders have a debenture trustee, it means that they are secured debentures. The only thing which the CARO auditor should check here is that adequate security should be created in respect of secured debentures. So if the value of this, see, all the values that we write in the balance sheet are called as book values. But when it comes to redemption, the debentures are not going to be redeemed at book value. They may be redeemed at book value at par, or they may be redeemed at a higher value also. They may be redeemed at a premium also. But that time, this land and building should be sufficient enough to pay the premium money also. So if the land and building is of 1 CR, at the time of issue, the debentures were 1 CR. But the debenture trustee agreement says that when the debentures will be redeemed, they will be redeemed at a premium of 20%. So it will be 1.2 CR redemption value. But that time the land and building should also become 1.2. Suppose if the land and building, this land and building both have become old, they are at the stage of demolition and land has become barren now. You know, when a property which is shown in the asset side, suppose let's take an example of a property. They write in asset side land, but when the auditor goes and inspects the land, whether really land is there or not, he inspects, okay, land is there, but it has become barren land. Not even one crop can grow here. You know that whenever properties which look properties in balance sheet, but I asked to this person who was taking care of this land, the caretaker, sir, can you tell me what is the value of this land today? Because in balance sheet it is showing 100 crores. You know what did the caretaker told me? Forget sir 100 crores. If you will sell this land, you will have to give 5 lakh rupees to the person who will buy this land from you. Only then this person will buy this land. So in the balance sheet it is still appearing as property. Okay, it's a very old, 100-year-old land. It is still appearing at 100 crores, but when I will sell it off, the person is not going to pay me. In fact, I will have to pay the person to sell off this land. You cannot do cropping here, you cannot do construction here, then what's the purpose of this land? Normally we see land is subject to appreciation, that is why we don't charge depreciation. But this type of land is called as, you know, onerous land, or it is called as onerous property. What do you mean by onerous property? Onerous property is a property which appears to be asset, but actually it's a... So you have to always make provision for onerous properties. Now where will you get this 5 lakh rupees? You'll have to make provision for it. What I am telling you is the same treatment given in accounting standard 29. In somewhere at the end, AS 29 says onerous properties. So onerous properties are those which appear to be properties, but actually they are not. They are liabilities for the companies. So only when you do physical inspection you come to know, because in the balance sheet verification you will always find that they have some value. So auditor has to see all these points before deciding whether this transaction which is taking place is adequately secured or not. So if debentures are issued, they should be secured against land and building, and if the land and building is not going to fetch them adequate money at the time of redemption, then the debenture trustee will appoint a liquidator who will liquidate this land, and if it is not able to liquidate, then some other properties will be secured. But since it is secured debentures, it will always have a charge on the assets of the company. Whether it is the direct charge on land, or when the asset is not identifiable. Suppose you will say that, sir, if the land is not able to fetch any money, then what will happen? Then we will create a charge which we will call as a floating charge. The floating charge keeps on floating on the assets. Okay, and the land, when it is directly identifiable, it is called as a fixed charge. So if you can identify the asset, it's a fixed charge. Otherwise, If not land, then let's take motor car, let's take furniture. As long as we are not able to repay the money, we will keep on creating charges. Have you understood or not? So you have to see this point in CARO. You can read it, it's on page 39. Clause number 20. Clause number 20 is on initial public offer. So whenever a company makes a public issue, whatever was the reason for making public issue, suppose in the prospectus, what do you mean by prospectus? Can I say it is only an offer? It is not an, now it will become an offer only when the shareholder accepts it. Till that time it is an invitation to offer. So now this prospectus, when it was given to the shareholder, when he accepted the prospectus, he saw that the IPO money will be used for some power sector project. But then, you know, Reliance Power came out with a power sector IPO. In 2009 they came out. And after this IPO, the share market is literally collapsed. In fact, the purpose of bringing an IPO is to improve the market conditions, but here the market went into depression. So now, what was the reason? Maybe because the money was not utilized for the purpose for which it was obtained. Same as term loan point. If you are taking a term loan, you should use it for the purpose for which you are taking it. Likewise, IPO money should be used for the purpose which is specified in the... An auditor should always read this prospectus. And after reading this prospectus, if an auditor does not report this point, if this type of case happens, that the money in power sector was used to make Anil Ambani's home, instead of putting it in power sector. So in that case, what will happen? Auditor will be held guilty for that. You know, section number 62 of the Companies Act says that, section number 62 of the 1956 Companies Act says that if an auditor certifies a prospectus as true and fair, and if he does not report this point, if suppose the contrary happens, then it is a criminal liability on the auditor. And in case of criminal liability, what is the punishment? No. 2-year imprisonment is section 628. That is a different section. This is exclusively for prospectus only. This is for not for any other reason but for prospectus. You can't tell out anything. Listen to what I am saying. If the prospectus is read and if the contrary happens, then there is a criminal liability in which auditor's personal assets will be attached. So sell home, sell office and repay the money. And if that is also not sufficient, then you will go into imprisonment. So now, this is section 62, criminal liability for misleading prospectus. So if there is a misleading prospectus or if there is a false information contained in the prospectus, and if the auditor has certified that prospectus as true and fair, or if he is not writing this point in CARO, it is a criminal liability on the auditor. So he should be very, very careful, especially when a company comes out with a public issue, initial public offer. Just one thing you have to see, that the money of public issue should be utilized for the purpose for which the issue was made. Okay, you can read clause number 20. Now, just last point remaining, please pay attention. Clause number 21, the last clause is on frauds. You can give reference of this clause when you are writing answer to essay 240. It is advisable that if you give reference of this clause also along with 240, the quality of your answer improves and quality of marks also. What do you mean by this clause? It's very simple. During the course of audit, that means when an auditor is auditing financial data, if he notices a fraud, or a possibility of a fraud, if he notices a fraud or a possibility of a fraud, then as per CARO, he has to report the fraud. He will report who did the fraud. That means he will report the whole nature of transaction and what was the amount which was involved in the fraud, amount of fraud. Two things he will report: nature of fraud, amount of fraud. Nature means who did the fraud, who was the culprit, and what type of, how much was the quantity in terms of numbers which was there in fraud, quantifiable in terms of numbers. So you will report this point. Sometimes auditors don't report the fraud because they are scared with the management, because they know that the management is going to pay them. So then CARO also says one more thing, that if you're scared of management and so you're not reporting, you have to write the reasons why you're scared from the management. If you're not scared, then you write adverse opinion. Now if you're not writing adverse opinion, you're writing an unqualified opinion, it means you have to write the reasons why didn't you write adverse opinion. Have you understood or not? So see, all checkpoints on auditor, control on auditor, as long as an auditor is faithful to shareholder, he is like a dog. Otherwise, he is like a, he will be a culprit and he will be thrown out of the company. Shareholders are going to just throw chappals on him if he do this type of act, because now CARO makes it mad. And you see, I've underlined that in bold para on page number 39, clause 21. He has to write the reasons why he is not reporting the fraud. So it's a very painful task on the auditor. How can he write the reasons? Ultimately, he has to report for the fraud. Have you understood or not? This is clause number 21. You can read it from the textbook. CARO is completed.